What is up, traders, and welcome back to Explain the Charts. Today is October 29th, 2025, and we are taking a deep dive into the AUDUSD, the Australian dollar versus the US dollar. We have a lot to cover today, from some market-moving news events to a very interesting technical setup on the charts. So let's get right into the fundamental picture. First up, we have some significant data out of Australia, with reports that consumer prices rose at their fastest quarterly rate in over 2 years. This jump in inflation typically puts pressure on the Reserve Bank of Australia to consider a more hawkish stance, which is fundamentally bullish for the Aussie dollar. On the other side of the pair, we have the U.S. Federal Reserve, which recently made the decision to cut its benchmark rate by 25 basis points, down to a range of 3.75% to 4%. The FOMC cited slowing job gains and elevated uncertainty as key reasons for the cut, which is generally a bearish signal for the US dollar. Interestingly, the Fed also announced it will stop shrinking its balance sheet on December 1st, ending its quantitative tightening program. This move further reinforces a more dovish and therefore bearish outlook for the USD. The broader market sentiment appears to be risk-on, with global stocks rallying to new records. This environment often benefits commodity-linked currencies like the Aussie and weakens safe-haven currencies like the US dollar. However, despite these bullish fundamentals for AUDUSD, some analysts are pointing to technical weakness. One report described the pair as being in a game of Pong, caught in a range between 0.6480 and 0.6521. They noted that momentum indicators like the RSI and MACD are suggesting sustained downside pressure, favoring a bearish bias, with a potential target near the 0.6400 level. So we have a classic battle between bullish fundamentals and a potentially bearish technical structure. Alright, let's pull up the daily chart and see how this all translates into price action. Looking at the bigger picture over the past year, we can see a clear downtrend that began after the pair peaked in late September 2024, right around the 0.6937 level. Following that peak, we saw a massive sell-off, particularly on October 4th, 2024, where the price dropped almost 3% in a single day. The downtrend continued into the new year, with some extreme volatility and flash crash lows seen in late December and January, establishing a major long-term support area. The price then staged a significant recovery but has since resumed its downward trajectory from the more recent highs set in September of this year. Now, let's zoom in on the price action from the last few months to get a clearer view of the current trend. Since topping out around 0.6688 in late September, the pair has been in a well-defined bearish channel. We can see a series of lower highs and lower lows, which is the textbook definition of a downtrend. The sharp drop on October 10th pushed the price down from 0.656 to a low near 0.647, establishing a key support level. Since that low, the price has been grinding its way back up, which could be fueled by the recent dovish Fed news we just discussed. Currently, the price is trading around 0.658, directly testing a critical area of prior support that may now act as resistance. To get a better feel for the short-term momentum, let's switch over to the 1-hour chart. Here, we can see the anatomy of the recent price action much more clearly. Notice the sharp sell-off on October 10th and the subsequent consolidation period. Following the low set around 0.6438 on October 14th, the pair has been forming a bullish structure, putting in a series of higher lows. This indicates that buying pressure is stepping in at progressively higher prices on this time frame. However, you can see the struggle right here, around this 0.658 to 0.660 zone. This area acted as a floor for the price before the big drop, and now the bears are trying to defend it as a new ceiling. This concept of old support becoming new resistance is a critical technical principle to watch. Finally, let's drill down to the 15-minute chart for the most up-to-date picture. Looking at the past few trading sessions, the intraday trend has been undeniably bullish. We're seeing a steady and consistent climb from the 0.653 area on October 26th up to the current price action. This confirms the short-term buying pressure we identified on the hourly chart. The key question now is whether this intraday strength has enough momentum to break through the significant overhead resistance we are currently testing. Okay, let's switch back to the daily chart to put it all together and recap. Fundamentally, the scales seem tipped in favor of the bulls, with high Australian inflation and a dovish US Fed. Technically, the larger daily trend is bearish, but the short-term and intraday trends are bullish. This puts us at a major inflection point. The key price levels to watch are critical. For resistance, we are currently testing the 0.658 to 0.660 zone. A break above this level would target the September high around 0.6688. For support, the October 10th low around 0.647 is the first key level. Below that, we have minor support at 0.6465 and then the major double bottom area around 0.6400. So, what are the potential scenarios? The bullish scenario, which I'd give about a 40% probability, involves the price decisively breaking and holding above 0.6600. This would signal that the bullish fundamentals are overpowering the bearish technicals, potentially starting a new uptrend. This would be reinforced by continued US dollar weakness across the board. The bearish scenario, which I'll assign a 60% probability to simply because it follows the dominant trend, is that this 0.6600 resistance area holds. If we see price rejection here, like a strong bearish engulfing candle on the daily or hourly chart, the path of least resistance would be back down. A break below 0.647 would then open the door to that 0.6400 target. The most important thing for traders to watch right now is the price action in this immediate 0.658 to 0.660 vicinity, as it will likely dictate the next major move. That is my analysis of AUDUSD for today. If you got value from this video, please hit that like button and subscribe for more in-depth content from Explain the Charts. Before you go, please remember that this is not financial advice. This content is for educational and informational purposes only. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. Always conduct your own thorough research and consider your risk tolerance before making any investment decisions. Trade safe, everyone, and I'll see you in the next video.